The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Thank you for joining us today. We're back with another very special interview I'm really excited about. We're here with Max Frumes, who's the author of the Caesars Palace Coup, How a Billionaire Brawl Over the Famous Casino Exposed the Power and Greed of Wall Street. So as I've mentioned before on this podcast, I kind of have a rule that the first time somebody recommends a book, I'll put it on my list. Second time, I'll bump it to the top. Third time, I'll pull the trigger. And for whatever reason, I had 3 or 4 people that I really like recommend this book to me all at once in January. And I just read it and absolutely loved it. I would put it right up there with Liar's Poker, Barbarians at the Gate, Monkey Business, The Big Short, in terms of just the behind the scenes, inside baseball kind of look at how a little corner of Wall Street actually works. And there are some moments in this book that are so hilarious and so cringe-inducing. I don't even know how to quite describe them. We'll get into a few of them. But anyway, Max joins us today. He leads a team at Fitch Ratings covering corporate debt and restructuring activities. He was previously the founding editor of a bankruptcy publication. Before that, he was at S&P in the leverage commentary group. He graduated from Berkeley, did a master's at Medill. And so, Max, thank you for joining us.
Phil, thanks for having me. It's great to be here.
And so I want to dive right in. This book is aptly described by you guys as the most brutal corporate restructuring in Wall Street history. So why is that? Give us a little bit of background about the case and tell us why you think this one happened to get so nasty and so ugly.
Great. Thank you for the intro. And let's give full credit to my co-author, Sajid Indab from Financial Times, who toiled along with me for the better part of 4 years to research and write this book. And we thought that Caesars, while there have been larger bankruptcies where there was more assets and more liabilities, there have not been more contentious ones. And we thought that was because this represented the fundamental investment thesis for distressed debt investors going back a long time, which is good company, bad balance sheet. There are fewer and fewer of those opportunities, but that was Caesars at the time, that very quickly after its mega LBO in 2008. And the reason was that this was one of those mega LBOs that happened at the height of the market, which was agreed to in 2006, but didn't close until 2008 on the eve of the financial crisis. And so the valuations were sky high, and ultimately the impact to the company itself wound up being so dramatic for a number of reasons that it couldn't pay its debt service. And because one of the peculiarities of the private equity sponsor, Apollo, they were so creative and so brilliant, and so aggressive in their liability management of the giant capital structure, which was about $25 billion at the close of the LBO, to keep, extend the runway until the company bounced back. That it angered a lot of the creditors, and the creditors themselves wound up becoming distressed debt investors, with the main examples being Oaktree and Appaloosa in this case, who were adverse to Apollo, who had their, there were these heavyweights on the other side of it. So you had heavyweights, famous billionaire investors and very influential, well-capitalized investment firms on both sides, on many sides of these transactions, fighting over the fate of this company and the control of this company and the recoveries in a restructuring made this, we think, the most brutal fight on Wall Street.
One thing that jumped out to me too was that you mentioned, so this, we'll get into a little of the weeds and the terms and the technicalities here. So John, Elliot, you guys jump in if we're throwing around terms that aren't clear to people. But one thing that jumped out to me was, as I was preparing for this, reading the endnotes, is so Apollo came along. They probably overpaid for this. They kind of admit they overpaid for this right on the precipice of the financial crisis. And then the whole thing kind of blows up 2009, 2010. It's pretty clear they're going to hit a wall, but they're able to keep the company on life support by basically shuffling the deck chairs on the Titanic in what other creditors ultimately deemed was asset stripping, right? Like taking away the collateral that they thought they were entitled to. And they got the blessing of various parties. And one thing that jumped out was that Paul Weiss, the law firm, decided to basically go scorched earth on you guys, threatening to sue you and Sujit for defamation before a first draft of the book even existed. So, I mean, doesn't that kind of tell you all you need to know about how implicit they were in kind of pushing this into the gray area, if not, past the gray area?
Without getting too much hot water, I think that's very indicative. Part of that is I think that the threats weren't as explicit as all of that. It was asking to see a copy of the manuscript before we had even had one, to look for things that could have led to defamation claims. But this whole case, it brought up two things. One was, what is proper corporate governance for a company that is heading towards insolvency, right? And then what are the conflicts of interest in the different sides of a company that has creditor constituencies and shareholders who are going to be adverse to one another if a company is heading towards insolvency? And then what are the lengths of the advocacy that law firms, investment banks, and the like that are beholden to their private equity clients who are really supposed to be representing the debtor or different parties. And in this case, it brought up a very interesting question that at least was somewhat answered by the independent examiner in the case. Which was, at what point was Caesars insolvent, and therefore, at that point, did the creditors or the opco that had issued all the debt that was being compromised at this time deserve their own representation in the decisions that the company was making? So before that, Paul Weiss was operating as the counsel to both the debtors and the sponsor. And ultimately they had to replace them as counsel for the debtors. Kirkland Ellis stepped up. And then when the examiner's report came out, they were kind of replaced entirely in this one scenario. But what we, I think, did a great job in reporting for the very first time in this book was the extent to which Apollo was such a key client for this very influential law firm that has put itself forward as a law firm that is for social justice and a number of very prominent causes. Also being a zealous advocate for all things related to Apollo, up to and including representing Leon Black with regards to his current trouble, various legal troubles after he had to step away from the CEO role. So they were the top client for Paul Weiss, and up to, I think we got confirmed about 7% of the revenue, but we heard anecdotally it was more than that. That's a lot for one client. And I think that you can't help but have your behavior shaped by that.
Yeah.
And but it wasn't just them. I think it was also Kirkland and Ellis has a huge practice of representing private equity firms, and that has helped their restructuring practice. Right. In this, it was interesting that Apollo was like one of the private equity firms they didn't have as many mandates with, but it's pervasive in the industry to be beholden to very, very powerful and influential large money fund managers, even though you could be representing parties that are adverse to them.
Yeah, right. So on that note, I mean, look, by the way, I think the incentives do tell all the stories here, right? Because show me the incentives, I'll show you the behavior, as the saying goes, right? And I think it's just plain as day to anyone who reads the book how conflicted and obviously conflicted various parties were, everyone from the advisors and the lawyers to the kind of stooge directors that were put in place at the company. So, and we talked a little bit about this before we started recording. It's a very small world, right? Like everybody knows everybody, often very close personal relationships, professional fates, all very tied closely together. And so you mentioned that I think you interviewed 200 people and read thousands and thousands and thousands of pages of documents in the multi-year process to research this book. So I'm curious what it was like in the weeds actually writing the book, and whether it was difficult to get people to even talk. You mentioned that pretty much everybody wanted to speak only on background. So were they happy to talk as long as it was on background, or what was that whole process like?
Yeah, thanks. I love these questions about the reporting process of, like the dark corners of Wall Street. Right? There's a funny saying. I forget who came up with it, but it's like, as a business reporter, you call up your sources and they won't even give you the time on the record, right? Right. So what we have to do as journalists is start a lot of conversations on background. What on background means is there's no attribution to the person you're talking to or to that conversation, but you can use the information in a story. And what this does is it separates maybe the accountability. Whereas if you can get an executive or someone to comment on the record, that means that they're out there in your story according to XYZ executive from this fund, and that's their position. That's clearly their agenda. If they're giving it to you on background, you have to negotiate. Well, is it a source familiar with the matter? Is it a source that's familiar with Caesars thinking? Is it a source familiar with Apollo's thinking? And this really allows the different Wall Street firms to manipulate the narrative. And our job as journalists in this world are to try to get the truth out of it. And in order to do that, you have to triangulate. So in this case, there were a lot of emotions, and there was a lot of money at stake. And ultimately, at the time where we were going back and reporting on this, the company filed for bankruptcy in 2015, and it lasted for 2 years. The plan was confirmed and emerged later in 2017, and we were reporting it out in 2018-19, and then writing it in 2020, published in 2021. So people had time to cool a little bit, and they had made so much money. A lot of them were super happy to talk about it. And so they gave us their version of how, much like they were super geniuses, and they did this, and were able to, beat their adversaries like this. And so that gave us leverage to then go back to the other side that may not have come out ahead. In this case, the biggest loser was Apollo and TPG, and that they made the initial equity investment in the LBO, and they, as hard as they fought, ultimately had to lose that entire initial equity check, and the creditors were able to take over, and all of them who bought at pennies on the dollar wound up recovering par or above. It was miraculous. There's a lot of really, really happy winners here, and a couple of not so happy losers. But once you get one side of the story, other people want to say it wasn't all cut and dried, right? It wasn't all because they were brilliant. There's a lot of luck involved here too. And so that's what I think made so many people eager to talk, was these different motivations that they had, and getting out a good story that would document maybe perhaps a victory, or setting the record straight so that there was a lot more color on just how the battle was fought. And yeah, like it was a very gratifying experience, but certainly very difficult when you have people who all have different agendas and are expert at trying to manipulate the narrative, telling you different things.
Yeah, it's got to be hard to sort that all out. And like you said, I mean, Apollo comes off looking like the villain here in a lot of ways, and particularly some of the personal behavior was, as my kids would say, cringeworthy. It doesn't even quite cover it. Did they push back? Was Apollo cooperative, or did they refuse, or did they just say you're getting it wrong, but you have 3 sources that confirm it, so you kind of go with it, or what was their response like?
We're not going to disclose who all we talked to, right?
Sure.
But we did go back to every single person and company who was mentioned and told them exactly what was going to come out of the book, and gave them an opportunity to respond and to add information and tell us whether or not it was incorrect. And that process, while laborious, was helpful. And there's been no major errors that we've heard on any side. So people may not be happy with their characterization, but so far, no one is really disputing any major facts in this book. And and I think that our philosophy going in was not that there are good guys or bad guys. It's not a Manichean story of good versus evil, right? At the end of the day, most of these firms don't look that great, right? Most of the motivation here is to make a lot of money. And there's just some self-righteousness attached to it in this case, because it does seem that there was truly egregious behavior on the part of Apollo and the sponsors in their liability management of this, right? In trying to extend that runway, which the examiner really gave the voice to. And we refer to Richard Davis, he was a former Watergate prosecutor who was the examiner that was chosen in this case. Just did this phenomenal job of getting people to talk that we never would have been able to get to talk, and putting that all on the record in this 1,800-page report. And he came out and he made real judgment calls that we relied upon extensively. And while none of it is legally binding, he said that there were very strong claims for actual, not constructive, just actual and constructive fraudulent conveyance in this case, and in addition to different corporate misgovernance and claims to the tune of $5 billion. And that was extreme. It was there could be, well, whoops, we stripped out an asset to try to extend the runway, and we lent against it, and maybe we didn't give the full the best valuation, but it was an it was an accident. We didn't think that we were insolvent. We didn't think those are things that it could be constructive fraudulent conveyance. This was actual, and so it that was part of the I think really unique portions of this, where you have this very well-respected, objective third party who came in here and got very good access to all the key players, and had a huge staff and his own investment bank and firm to go through millions of documents, right? Way more than we had access to, and then come down with this report.
Right.
For anyone who's really interested, that examiner's report, it's public, it's out there, and very much at least worth a read of the executive summary.
Yeah, and one last thing on the issue of incentives that I thought was a really fascinating point you guys made in the book was that, look, Apollo and TPG made this huge LBO, and obviously the price and the time were dead wrong, even if it proved to be, quote unquote, correct 10 or 12 years later, in the sense that the enterprise value was recovered eventually. But along the way, you had this a massive amount of value destruction and all sorts of shenanigans going on. And you had I think the total fees charged by the law firms just in the 2-year restructuring was $273 million, right? Over $250 million, according to the final fee approval from the judge. So you guys made the point that, the incentives here are for everybody to make the most amount of money for themselves, which is basically diverting money from the investment, from the business itself, into their own pockets, and that they're all capitalized, right? All the big players in this story were all capitalized by basically the same handful of limited partners, right? Like big pension funds and sovereign wealth funds. So have you ever gotten a read? Have any of those ultimate LPs read the book and kind of realized that, or is that just kind of acknowledged but not talked about?
Both. We got out there on the Capital Allocators podcast, and it's made the rounds to a lot of the LPs. I suppose the Venn diagram isn't as overlapping as we would make it seem, but there are, especially for Apollo, Oaktree, and the largest private equity firms, that are in this book, and the hedge funds, and the multi-asset managers, multi-strategy asset managers. Those are gonna all get some allocation from like CalSTRS, CalPERS, and Texas Teachers, and the like. And that is a great point, right? It's like, you could charge lower fees and maybe beat each other up a little bit less, and our overall portfolio would improve. But because it's not as much of an overlap, and there it is still an ego game. The funds, they have the discretion, and if their returns are better than their competitors, then there's the survivor bias where the LPs will start to give them more. So I mean, it's an interesting point, and I think the point that's not made enough is if you're looking at things through the lens of business ethics and even ESG or like what is the responsible thing to do here. Who are the most vulnerable stakeholders? In this case, they're hardly ever talked about, which are the pensioners, the employees.
Right.
And in this case, it's like, oh, it's kind of an afterthought, right? The creditors themselves, that are the lenders, they step into the role of what would have been, the institutional investors, the mutual funds, the insurance companies that bought the debt at par. They bought it at 30 cents on the dollar and stepped into that role and said, hey, we're getting a raw deal here, and we're standing up for the sanctity of the credit, the credit market. Meanwhile, I don't know. It's really tough to say how much you can say, okay, what's a better system? If these experts in restructuring and distressed debt investing, these negotiations, don't step in there, then they could get steamrolled by a sponsor, and that I think that does happen more and more. So it's tough to say what a better system is, but I do think that the most vulnerable stakeholders don't have real as vigorous and expensive representation in most of these mega bankruptcies.
Right. No, I agree. I don't think there's necessarily a way I think the horse is out of the barn, basically. I don't think you can improve it once you get to this point, right? Once you write the check as a limited partner, once the fund makes the investment, once the investment gets sideways and ends up in bankruptcy. I mean, that is, the process, I think, actually works reasonably well. It's just getting to that point, right? The incentives kind of metastasize on themselves and you get these crazy bonkers results. But, I guess it would just be interesting to make every investment committee at every one of these large allocators read this book before they write another check. Right? That was kind of my thought on that. I know that's impractical.
Do it. I love it. And I think I really do think it is helping in a lot of ways. Even throughout this case, Apollo did have to go on this mini apology tour. We included a little anecdote about that, where some creditors were so vehemently opposed to some of the stuff that they had done. There was this Apollo premium, so that the deals, their buyouts that required new debt were being charged a premium, because people were like, I don't know how they're going to do it, but when push comes to shove, right? Like, we're going to get the raw end of the deal here if it's an Apollo deal. They went on an apology tour for that reason. Said, we're gonna try not to do these types of things that so alienate our valued colleagues and peers in the market who are going to buy the debt on these deals. And that premium, I cover this on a day-to-day basis now. That premium went away. It's pretty much the same. So two things happened. The premium went away, but then every private equity firm saw Apollo do what they did in Caesars and were like, oh, okay, you know what? The reason they didn't get away with that was they didn't appoint independent directors soon enough.
Right.
So two things happened. Apollo actually modified their behavior, I think, probably a little bit more towards the cautious and conservative. And then, other sponsors modified their behavior more towards the aggressive. So now you see this type of, aggressive, let's say, credit exchanges, asset stripping, refinancing efforts by many sponsors, including Oaktree, right, which was the one of the unsecured creditors in this, or the junior creditors in this case, part of the second lien group. But they're out there doing very similar deals that are kind of priming junior creditors and leaving them with lower recovery estimates. Those are kind of the results of it. I think it's good to have exposure, as much transparency as many of these stories can get told. That'll improve things slightly. But there's always a little push and a pull.
Sure. Yeah. No, I agree. Getting Apollo'd was already a term and a risk that people were familiar with long before this bankruptcy came to a head. That's for sure. But like you pointed out, they certainly haven't had any trouble raising money even since, despite the myriad problems at the firm. So it's fascinating. I want to ask 3 quick questions about kind of the legal side. One of the more interesting and shocking legal angles here was that the judge in the case opened the door to at least the potential for personal liability on the senior executives at Apollo. Do you think that threat really had the potential for any teeth? I mean, at one point, Oaktree joked about getting discovery and putting the personal bank account details of the senior guys at Apollo on a billboard in Times Square. But I mean, that's as fascinating as that threat might. Yeah, as fascinating as that joke and threat might be, it just didn't seem like they took it seriously. Do you think that'll ever come up again? Do you think that'll be any sort of issue, or even, God forbid, a deterrent at any point in the future?
Well, I do think it was I actually think that was one of the key inflection points in this case. They would never admit it. And we do couch it in terms of there were many, many reasons why Apollo was heading towards the same result anyways, where they were willing to walk away from their initial equity investment. There are a couple of timing things about the deal that show that after the judge approved this essentially discovery request that would have delved into their personal financials, not necessarily that it would have gotten to the point where they were personally liable, but with this judge, it was kind of like a little bit of an unknown too. So that we do think, a lot of people thought that was one of the inflection points where it really was like, all right, you know what, we're going to strike a deal here. And like there's always a lot of factors that go into that, but ultimately the timing of it did seem like it was a pretty important factor in persuading them to settle and then stick with the settlement. Because one of the key, like on the day of confirmation, one of the key legal precedents that was working against them was kind of reversed when, with respect to the Marblegate and education management case. And their lawyer called them up quickly and it was like, should we stop it right now and say no deal? And it's like, go for it. Like, I think it was definitely a factor that coincided with the timing and the persistence of the settlement in this case. And I think is something that will be a factor going forward, right? I think like this book and all of the great reporting on the Purdue Pharma bankruptcy and a lot of the other, opioid bankruptcies. Mallinckrodt was another opioid producer that went into bankruptcy. It's been an interesting story. They are bringing up these questions of personal liability that I think benefit from this type of scrutiny and exposure, and ultimately should be held up as an example for why it's better business just to be a little bit more personally responsible or ethical, right? So I think it was a factor in this case. The fact that it ultimately didn't get to that point, and who knows what's going to happen with the Purdue settlement. We'll see. But I think that bankruptcy is such a unique forum where you have this business, right? And this business is run by individuals and owned by individuals. And if those individuals, do something bad, and the company goes into bankruptcy because of it, what responsibility do they hold? Well, if it's just monetary, maybe nothing, right? If it's beyond that, then maybe there is something more where it can break through that. That's a real interesting issue for the bankruptcy process right now.
Yeah, speaking of, I wonder what your thoughts are on venue shopping. For anyone who's not familiar, that's the idea that when a company gets into trouble and needs to restructure in court, there's some ability in certain circumstances to kind of pick the state and the court that they're going to be trying the bankruptcy case in. And in this case, it's kind of ironic, don't you think? I wonder if you agree with my assessment that originally there was a push toward Delaware, including from the second lien counsel at Jones Day, Bruce Bennett, who really wanted Delaware. They ended up getting a judge in Chicago where I believe there were 9 potential judges assigned that could have come up, and they really didn't want just one of them. They would have been okay with 8 of the 9, and of course they got the one of the 9 that they didn't want. He was known as somewhat of a wild card, and he certainly did produce some wild card moments. But I think you wrote in the book, which I think was a great point, that he was probably one of the very, very few judges in America that actually gave them enough latitude to try their case. So I wonder if you agree with that, and then also if you think it's kind of another angle of this, right? Like as the tools get sharper, people are just going to continue shopping for the venue and the judge of their choice to the extent they can, right?
Absolutely. So the Caesars case is extraordinary for this reason, also because it was where venue shopping was attempted, but wound up being an exception to what is the norm currently, and even for the past several years in the mega bankruptcy world. And that norm is that the private equity owners or the shareholders, people controlling a debtor or a company that is going into bankruptcy, can almost target a jurisdiction and a judge that will be friendly to a kind of a debtor side restructuring or a sponsor side restructuring. And what that means is there will be third party releases, right, that are frequently given in that jurisdiction, and or it's a judge that is known for being a deals judge. And in the past several years, there's been a couple of papers out on this recently. It was remarkable, and it was like something like 60% of mega bankruptcies were going to three judges, right? The two that were in Houston, and then Judge Drain. And if you filed in White Plains, you were guaranteed to get a specific judge, and so that is kind of the norm. In this case, they thought that Chicago and Illinois in particular could have been a good venue for them for a number of different reasons, including the third party releases, but because they got Judge Goldgar, and for various different reasons, he didn't allow the case to proceed at a pace that would have benefited the sponsors and the people that controlled the company. So I think it was very fortuitous for the junior creditors in this point, and then ultimately he made some decisions that other judges might not have made.
Yeah, and to hammer home the point, I think there are various scenarios where the junior creditors who are buying up a lot of their claims between 10 and 30 cents on the dollar, I think at various points along the way, and thought, boy, a total home run here would be 50 cents. And they ended up getting par plus through some equity recoveries. I mean, this was a swing of like $3 billion, right? That could have been limited, quote unquote, to just $1 billion or $2 billion had the judge not given them this latitude. So it really was meaningful. And the last thing I want to bring up on the courtroom and the judge side of things was just, there were like 4 or 5 moments in this book where I was reading most of it on an airplane, and my wife had thought I'd lost my mind because I was laughing out loud at this nerdy finance book. But one of them that I think everybody listening to this podcast will appreciate is there's a moment in the courtroom where one of the advisors is presenting his analysis, and he comes up with a $6 billion theoretical equity value for the new Caesars, which he calls, quote, an intrinsic value, a term that I'm sure all of us are familiar with. But the co-head of restructuring at Houlihan and the judge himself start attacking this term. And they said, so intrinsic value is not a technical term in corporate finance circles. It's a Brendan Hayes term from his testimony before. And he goes on, yes, this is not a term I commonly use when I'm talking about shares or anything like that. And so the lawyers pick up on this and they say, let me ask you a question. That you don't use the term intrinsic value. Is that a common and acceptedly and generally accepted corporate finance term? And the head of restructuring at Houlihan says, I don't believe it is. No. The lawyer goes on, okay, now there are treatises that are written about corporate finance and corporate valuations, authoritative treatises that you would recognize as such. Yes, there are. Have you heard of Graham and Dodd, their treatise or a book on security analysis? You go on to say that, obviously Graham and Dodd are kind of the godfathers of fundamental analysis and their classic textbook. And you're quoted in the book as saying, or you wrote in the book, that they were as famous as finance thinkers could be, but apparently not famous enough for the co-head of restructuring at Houlihan and Lokey. At which point he admitted, I have actually not heard of them. And the lawyer responds, you have not heard of that? And the judge continues to admit that he's not heard of that. And as soon as the hearing ends, Kirkland Ellis ships a copy of Security Analysis to Hilty's office in New York. So I found that whole thing both kind of frightening and pretty hilarious. So I don't know how that story came up, but I sent that around to several people I knew as soon as I read it.
It was great. It was great. Yeah, you had to have heard of it, right?
That's what I mean.
If you got a judge, right? Like part of this is reading the judge, and you got a judge who's got for a lot of different reasons. He had a lot of skepticism about the debtors' advisors and their framing of things at this point. So this was just Hilty just gave him just enough of an excuse to kind of dismiss their explanation of intrinsic value, which was pretty funny.
Yeah, it was amazing. And again, even if this was a tactic they tried to play willful ignorance, I don't think it was successful at it. It was, anyway. So I've been going on up. John, Elliot, do you guys want to jump in with anything before we wrap up?
Well, that last story was fascinating to me. I think the whole thing was really interesting. I like reflect back on how much things have changed in finance. I guess in the backdrop of the economy from when this whole ordeal started to where it's at now. See Caesars out there as like a publicly traded security stock again, and I just wonder, what you think of the future of these kinds of big buyouts. Do you think there is a little bit of a pause that people take in different valuation environments? Like, what do you think are some of the big ramifications down the line here?
Yeah, I mean, that's great. Will we ever see another heyday of the private equity club deal to produce a mega buyout at the top of the market? They're frothy enough, probably, but I think that what we're likely to see is what happened in 2020, where there's these abbreviated moments of opportunity where the largest investors who have sophisticated distressed investing strategies raise a ton of money, buy up a lot of assets, on the cheap, and aim to have dry powder or the ability to raise capital quickly to take advantage of those environments. And then, I don't know, like maybe the fiscal stimulus will come in and ruin those opportunities quickly, like or at least bring the market back up to the point where they're not as discounted as they were. But we saw that Apollo came back in, is going to be on the Las Vegas Strip again with the acquisition of the Venetian, and one of the main players in the Caesars saga, David Samber from Apollo, subsequently appointed to be the co-head of private equity at Apollo. He got up in front of the Nevada Gaming Commission and he gave public commentary on the differences between the two deals. Venetian was at the bottom of the market. Like there wasn't as much debt. It wasn't. It was a much different opportunity. And they learned their lessons on when to try to get into what is these hot markets. So I think that's at least one of the lessons about mega buyouts by these investors that have experience in this. Other things where distressed investing is going they're kind of interesting in that in the last year or so, where debt capital has been very cheap. There was so much stimulus that came into the markets that bailed out companies that might have otherwise needed to go through a restructuring, that nothing has been that cheap. They've now started calling themselves opportunistic credit investors, right? Or special situations investors. Like nothing is really distressed. And they have to get creative in the ways that they deploy capital and get involved. And that takes the form of, writing huge checks in situations that are, like somewhat fraught in the case, like in recent cases, like Talon Energy, or looking at distressed SPAC financing, for instance, up to and including new kind of blockchain initiatives or what have you. So those are some of the innovative ways that these investors, I think, kind of have adapted to the current markets. Right now, it's I on your guys' last podcast or one of your previous podcasts, you talked about the uncertainty that there is in the current environment, with conflicts in Eastern Europe and like a whole major economy in Russia being uninvestable, and there being ripples throughout the market where people are just acting with emotion. So, and right now, distressed investors are, at the end of the day, they're value investors and are a little bit paralyzed in this type of market. But they're getting smart on a lot of these situations, and will look to understand them when the emotions kind of start to settle down a little bit. And we'll see what type of environment we're in then, because interest rates are rising. That's going to lead to more defaults. The appetite for the degree of fiscal stimulus is going to be lower. So, we could be looking at a very active market for the types of investors that are characterized in this book.
Can I jump in with, or Elliot, did you have a follow-up?
Just one quick observation. I mean, it is interesting how these things repeat themselves. Like Barbarians at the Gate was like not that long ago in the grand scheme, but a little before this. And then, I guess one of the other things that was really interesting to me that you referenced there too. But KKR bought Alliance Boots at a similar time, and both that and Caesars ended up like kind of money good. Is there something to be said about the quality of the assets, or is there something just crazy with the amount of leverage that people put on these? I wonder about those things.
Yeah, I think like the on the downside too, right? Your liquidity is not going to last as long as the irrationality of whatever situation's going on. But I think these big investments, they're premised upon pretty good established companies that are likely going to grow in value. It's just, is there going to be a hiccup where you've levered it too much and they can't make their interest payments, and you're going to hand control to the creditors? And that's it's a real balance right now. I don't think that they're always going to get it right.
So I have kind of a beginner question, I guess, when it comes to this kind of stuff. Apollo was one of the big equity holders that I guess lost all their money. What was the other one?
TPG.
Yeah. So I guess the question is, if these guys really believed that there was so much value in Caesars, I mean, they got huge funds. Couldn't they have just paid off the debt, kept control of the equity, and then tried to relever?
It's a great point, and we tried to provide a comparable situation in Blackstone, right? Like in their investment in Hilton, where it's roughly similar sector, and they put more money in and wound up being one of the best returns that they ever got. There's some key differences with Caesars in that about a third of Caesars EBITDA came from Atlantic City, and then Atlantic City post Great Financial Crisis was just decimated because all of the northeastern states started issuing gaming licenses, and that building casinos, so the revenue never actually came back. And so that was just one huge structural change that never would have changed things. And the leverage was maybe a little bit too much. So if you're talking about their initial equity check, it was $6 billion between the two private equity firms, with a lot of that being provided also by other co-investors. So they're at most are only putting in $2 billion each, and the debt that was distressed was $18 billion. It wasn't a great return that they were looking. There was other opportunities that they could put capital work for better return. Otherwise, they probably would have done it. And they're known for doing that, for buying back their own debt at a discount and then benefiting from it. But in this case, it was just a little bit too much.
I know we're bumping up against our time limit here, so I just want to close with one quick thought, which is people who've listened to this podcast before know that I'm a huge fan of Matt Levine's writing at Bloomberg. I think he's absolutely brilliant and hilarious, and the way he explains things, he really knows what he's talking about. And when he dives into something, not only is it hilarious, but it's thought-provoking because it kind of makes you think about why things are the way they are. And no less authority than Matt Levine is on the back jacket of your book with a blurb that says, this is a superb inside account of what modern high finance is actually like: the strategies, the personalities, the relationships, the stress, and the shouting. fascinating, suspenseful, and comprehensive. It's the barbarians at the gate of distressed debt. And I couldn't agree more. I plan to give this book and recommend this book to absolutely anyone who I get the question, from time to time, what's this stuff really like? How does this stuff really work? And this book is just a fantastic example of that. So Max, thank you for joining us and congratulations again on the book.
Really, really appreciate you guys having me. This was a great discussion. I appreciate it.
Thanks again. Take care.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.